Hey everyone, welcome back once again to our CA Foundation Business Economics series where we are discussing business economic concepts in a most practical and crisp manner. So without wasting much time, let's get back to the video. Today we are covering chapter 6 of business economics, that's determination of national income, in which we will be covering unit 2, the Keynesian theory of determination of national income. So here is the introduction for the chapter. Introduction. The Keynesian theory of determination of national income, developed by John Maynard Keynes during the Great Depression, revolutionized the understanding of economic dynamics. This theory highlights the crucial role of aggregate demand in determining the overall level of economic activities, employment, and national income. According to the Keynes, insufficient aggregate demand can lead to prolonged period of unemployment, which necessitated government's intervention to boost demand and stabilize the economy. So government intervention is necessary. Then comes circular flow in a simple two sector model. So in a simple two sector economy comprising of household and firms, the circular flow of income illustrates the continuous movement of money, goods and service between these two sectors. Household provides factors of production such as labor and capital to the firms, and in return they receive some money in the forms of wages, rent, interest and profits, which they spend on goods or services produced by the firms, completing the overall cycle. Here comes example. Consider a farmer in Punjab who sells wheat, that's factor of production, to a mill, that's a firm. The mill processes the wheat and sells flours to households. The income earned by the farmer is spent on goods and services like clothing and education for his children, thereby continuing the circular flow. Then comes aggregate demand function. So the aggregate demand AD function represents the total demand of goods and services in an economy at a given period, overall price level in a given period. So AD is composed of four components. First is consumption, that is denoted by C. Second, investment, that is denoted by I. Third, government spending, that is denoted by G. And fourth, net exports, that is X minus M. So in India, a decrease in the price of essential commodities like rice and wheat can increase consumer purchasing power, leading to a higher consumption and overall increase in the aggregate demand. So consumption C is, let's say, rupees 500 billion, investment is 200 billion, government spending is 150 billion, and net exports is 50 billion. Therefore the aggregate demand will be 900 billion. Then comes the consumption function. The consumption function shows the relationship between consumption and disposable income. Keynes argued that consumption increases with income but not so rapidly. This function helps explain the marginal propensity to consume MPC, which indicates the proportion of additional income that is spent on consumption. So we have example for that. A middle class family in Mumbai earning rupees 50,000 per month might spend rupees 40,000 on consumption and saving the rest. So if their income increases to 60,000, they might increase their consumption to 48,000, showing a higher absolute consumption but a lower proportionate of additional income spent. So for 10,000 increase, they might spend 8,000 only. Then comes relationship between income, consumption and saving. So income is an essential income in an economy is divided between consumption and saving. So as income increases, both consumption and saving rises, but saving tends to increase at a higher rate than consumption, as people set aside more of their income for their future needs. Then comes average propensity to save, APS. So APS is the fraction of total income that is saved. For example, if a family in India earns rupees 1 lakh and saves 20,000, then their APS will be 0.20. That's 20,000 divided by 1 lakh. Then comes aggregate supply and the two sector model of national income determination. So aggregate supply AS represents the total output of goods and services produced in the economy at a given overall price level in a given period. So the equilibrium level of national income is determined where aggregate demand equals to aggregate supply. Then comes equilibrium with unemployment or inflation. So deflationary gap. A deflationary gap occurs when aggregate demand is less than what is needed to achieve full employment. This leads to unemployment as firms do not produce enough to employ all available workers. So in case of deflationary gap, there will be a gap between the demand and what are employed. Then comes opposite of its inflationary gap. So a inflationary gap occurs when aggregate demand exceeds the economic productive capacity leading to inflation. So we have example for it. Example, suppose India's full employment level of national income is 10,000 billion, but the actual aggregate demand is only 9,500 billion. So this creates a deflationary gap of rupees 500 billion, indicates that economy is not utilizing all its resources efficiently, leading to employment. So we have a table which explains both inflationary and deflationary gap. So for example, we have national income of 10,000 billion and we have aggregate demand of 9,500 billion. So there will be a gap of 5,000 in first case. There is shortage, so it's deflationary. And in second case, we have demand for 10,500, but actually our income is for only 10,000. So there will be an excess of demand, which is reflected as inflationary gap, which is 500 in our case. Then comes the investment multiplier. So the investment multiplier concept explains how an initial investment increase in investment can lead to a more than proportionate increase in national income. The multiplier effect magnifies the impact of investment on aggregate demand and overall economic activity. So we have an example for it. Example, if the Indian government invests 1000 crores in infrastructure product development and the multiplier is 2, then the total increase in national income would be twice of the investment, that is 2000 crores, stimulating further economic growth. Then comes determination of equilibrium income. So three sector model. The three sector model includes household firms and the government. Government spending and taxation plays a crucial role in determining national income. Then comes income determination with lump sum tax. So a lump sum tax reduces disposable income while it leads to a decrease in consumption and consequently aggregate demand, because since the tax is deducted, the amount which is in our hand for the spending will be less. So we since the money will be lesser in our hand, we will try to spend less, and overall the cycle will be off in a decreasing trend. Then comes income determination with lump sum tax and transfer payments. So transfer payments like subsidies or unemployment benefits increases disposable income and thereby boost aggregate demand. So example, if the Indian government imposes a lump sum tax of 1000 crores, consumption might decrease by rupees 800 crores, reducing into aggregate demand. However, if the government simultaneously provides 1000 crores in subsidies, the net effect of aggregate demand might be neutral or even positive. There comes determination of equilibrium income. So four sector model. So the four sector model expands the three sector model by including the foreign sector, that's net exports, that is export minus import, influenced by determination of national income, especially in an open economy like India. So where we have a same example continued, where consumption is 5,000 billion, investment is 2,000 million, government spending is 1,500 billion, and net exports are 500 billions. Therefore, the aggregate demand will be 9,000 billion. Then comes to the final end of the chapter. We have two more part. First is MG extras. So as usual, we have a short practical activity which will help you to understand some of the concepts in a better manner. So here we have MG extras, where you have to analyze the GDP data of our country for past few years and compare it with four other countries. Then comes to the conclusion of the chapter. That's the Keynesian theory of national income determination provides a comprehensive framework for understanding how aggregate demand influences the overall level of economic activity. By analyzing the interaction between consumption, investment, government spending, net export, policymakers can better address issues like unemployment and inflation, which ensures a stable and balanced economy. So that's it for the video. Thank you. Stay connected, keep learning, keep growing, and keep enjoying. Bye bye.